Good afternoon, everyone. This is Brian Hartstein, the Director of Corporate Development at Baintree Wealth Advisors, and I also head up the 401k team here at Baintree Wealth Advisors. So today, it's hard to believe it's June already, but the June 401k educational module we will be discussing is understanding your 401k provisions. That is everything that is specific to your 401k plan. And we find that we field a tremendous amount of questions from plan participants about these. So we thought we would address that in our June topic to make sure that everybody understands what each of those provisions means and entails and how it affects you and your participation in your 401k plan. We won't be discussing ones maybe specific to your plan, but in general, what they mean and how they apply and how understanding them can help you maximize your 401k account. So just to review here, your team at Baintree that is dedicated to working with you on your 401k plan. Again, it's myself, Brian Hartstein. We've got Jonathan Jengle and Chris Roger, who you've heard from before. We're financial advisors who help answer questions, work with participants from everything on specific questions in regards to investments, how to allocate your account, what your risk tolerance might be, financial planning related questions, anything that you may need help with to help you optimize your account. Casey Donlan's the newest member of our team. We just brought him over. He's been incredible, and we are lucky to have him aboard. And Jessica Amaya and Reno Blanco round out the team. So again, there's never any cost to you as an employee or participant for you to access us, our services, and our help, and our technology. So we really urge you to reach out to us if you have any questions whatsoever, or if we can be of help in any way in regards to your planning. So again, a little bit about what we're going to cover today. We're going to talk about these plan provisions, which are so important to you and your plan. We're going to look at eligibility and entry dates. We're going to talk about types of contributions, your contributions and your employer's contributions. We're going to talk about what vesting means, whether or not you may have loans in your plan and how those apply. And also, it may be everybody's favorite part is withdrawals. How do I access the monies within my accounts? So we're going to jump right in because we don't want to make this too long today, but we do have a lot of ground to cover. So when we look at eligibility, normally we will see ages of 18 or 21. We will never see an age beyond 21, but in most cases you'll see it as 21, but it can also be as young as 18. Period of service means how long you have to be with your particular employer to qualify for your 401k. This can range anywhere from several weeks to 1 month to 3 months up to 1 year. You most likely will never see eligibility beyond 1 year of service, and that is from your date of hire. And where we see a lot of questions come in is the difference between eligibility and entry dates. What do those mean? Once you satisfy eligibility, you can then enter the plan and participate at the next entry date. So for example, if your eligibility is age 21 and 1 year of service, and you were hired 1 year ago today, then you're eligible today, but you cannot enter the plan until your next entry date. And those entry dates can vary plan by plan. Sometimes they could be weekly, sometimes they could be monthly, they could be quarterly or semi-annually. So for example, if we were on quarterly entry dates and I satisfied my 1 year of service today, the next entry date for the next quarter would be July 1st. If I didn't satisfy my eligibility until July 15th and I was on a quarterly entry date, I wouldn't enter until October 1st. So it's important to understand the difference between what your eligibility and your entry date is. And so we do get questions on that. If you have questions, please feel free to call us. We can hopefully walk you through them and answer those very quickly. Your contributions. So for the contributions that you decide to make from your own pay into your account, you can do those in two forms. You can make those traditional 401k contributions, or what we call Roth 401k contributions. And I'll talk about the difference in a minute. The most that you could put combined one or the other or combined for 2021 is $19,500. You cannot put more of that from your own pay into your account unless you are over age 50. And in that case, you can make an additional $6,500 contribution so that your total contribution will be $26,000. So again, under age 50, it's $19,500. Over age 50, it's $26,000. Those limits might go up in 2022, but we are not sure yet. So we will wait and see and certainly update you when those changes occur. So many questions we get are, hey, what is the difference between traditional 401k contributions and the Roth? And then also, what is right for me? The difference is tax related. If you put your money in the traditional 401k plan account, you will not be taxed on that money today, and you will not be taxed as it grows. You'll only be taxed when the money's come out of your 401k plan or out of an IRA account where it may end up when you retire. So no tax today, no tax now, but you'll be taxed in the future. So those are for people that want some tax relief today. Roth contributions work in reverse. You do pay taxes on those contributions today, but you do not pay taxes while they grow. And when you go to receive them when you're retired or you separate from service, those are tax-free. So that you're not worried about what tax rates are today. You're concerned with what tax rates are in the future. And obviously, we do see younger people gravitating more and more towards the Roth 401k, but that also doesn't mean it doesn't apply to people that are older. We get questions about what's right for me, and the answer is it depends. So if you are not sure, please feel free to call our team here and we can certainly walk you through what might be the best options for you. But again, the difference comes down to tax. Do you want to pay the tax today on those contributions, or do you want to pay the tax in the future when they ultimately come out of your plan? That's the whole difference. So some people choose a combination. Some people choose one or the other. You could start with traditional and then decide to switch to Roth and decide to switch back. You're not locked in to making contributions for the life of your plan. Once you set it, you can always make changes along the way. Just like you can make changes to how much of your pay you're deciding to put in your account. One year you might put in 3%. Next year you could put in 4%. Next year you could put in 5%. So you can always make changes to your contribution percentage or hard dollar amount whenever it's feasible inside your plan. Now, your employer contributions. And that can be a little different because some people are in what are called safe harbor plans and some people are in non-safe harbor plans, and there are differences. In a non-safe harbor plan, you have a variety of different options for employer contributions. Some plans don't have any. Some employers say we're going to put 25 cents of every dollar into your account up to 3% of your compensation or up to 5% of your compensation. A common one is we're going to match 50 cents for every dollar you put in up to 6% of your compensation. And there's also options for vesting, meaning when am I entitled to all of the money that the employer puts in on their behalf? I'm always entitled to 100% of mine, but when am I entitled to all of the employer contributions? Some plans, you have to work at your company for up to 6 years from your date of hire, not date of participation, but date of hire for you to be fully percent vested. For example, at the end of 2 years, you're 20% vested, then 40, then 60, then 80, and at the end of 6 years, you're 100. If you're already been working for your company for 6 years in that instance, you're already 100% vested. Some companies have what we call a 3-year cliff, meaning you're 0% vested until the end of 3 years from date of hire, and then you're 100% vested. So it's important if you're in a non-safe harbor plan to understand what the matching amount is and what your vesting schedule is. Safe harbor works a little bit differently. There's only 2 formulas. The first formula is your employer will match dollar for dollar up to 3% of your compensation and 50 cents for the next 2% of your compensation. So simplistically, if you put in 5%, your employer will match 4%. The other formula is 3%, or excuse me, a dollar for dollar match up to 3% of your compensation, whether you put your own money in or not. The first formula is predicated on you making your own contributions to your account. The second one, they will make contributions for up to dollar for dollar, up to 3% of your compensation, whether you decide to participate or not. You just have to be eligible. So they work a little bit differently. But those safe harbor contributions are always 100% vested from day one. So again, some big differences between what we call a safe harbor plan and a non-safe harbor plan. We do field a lot of questions on those. So if you have those questions, please feel free to call us. We'd love to be able to walk through those with you. Some plans utilize what's called the profit sharing component of their plan, meaning on top of a 401k, an employer might decide to put additional money into the plan that everybody can share in at the end of the year. Some plans utilize this, some plans don't, and some plans that utilize this may or may not make those contributions every year. They can choose not to. It just depends on how the company operates. Profit sharing plans usually have a vesting schedule, and I'm going to show you the next slide what that normally looks like. So again, your contributions, monies that you defer to your own pay, are always 100% vested because you've earned them. Vesting for employer contributions, again, can vary based on safe harbor or non-safe harbor plans. And if they use profit sharing plan, that can have its own schedule. So if we look below, this is an example of a safe harbor plan that utilizes a profit sharing plan. So the bottom is your safe harbor contributions. Again, 100% vested from day one. But the profit sharing plan contributions don't vest fully until the end of year 6, meaning you have to be with your employer from the date of hire 6 years before you get to take 100% of that profit sharing monies with you when either you retire or some other event occurs. If you left, let's say, at the end of 3 years, you have 100% of your safe harbor matching, and you have 40% of your employer's profit sharing. So hopefully that made sense. It can be confusing for some. That's one of the reasons we wanted to kind of walk through it in this educational format. But again, if you have questions, please feel free to give us a call. Loans. Loans may or may not be permitted in your plan. Those are defined within your what's called your plan document, or what's called the summary plan description, which you as an employer are entitled to receive if you've not already received one. And that goes over all the specifics of your plan with your employer. Now, if a plan does provide for loans, the plan may limit the amounts that can be, or the amount of loans you may have outstanding, or the amounts that can be taken. But the maximum amount a plan can permit as a loan is either the greater of $10,000 or 50% of your vested account, or $50,000, whichever is less. So I know that's a little confusing, but we don't deal with loans too much because as financial planners, we do not think that your 401k account is the best place to borrow from. If you're doing your planning right, hopefully you've set up other areas where if there's an emergency or you need to go get funds, you can go get them from that particular place, not from your 401k account. Your 401k account is really designed as a retirement vehicle, and loans can negatively affect your account over time. Not that you can't borrow from them, and we understand that if you have an emergency or you have no other resource, that may be where you go. But if you ask us in a general, we would say, look, we don't think it's the best place for you to borrow from. So let's look at your whole financial picture. Maybe we can find another place which may be more beneficial. And if you don't have another place, we will help work on your planning with you to maybe set up an emergency fund that you can then have as in times of a need, as opposed to taking it from the 401k. But many people do have loans inside their 401ks as an option, and we do want people to understand what those mean. And if you need help with those, we can certainly help in that area as well. Now, most people want to talk about this part, and that's, well, withdrawals. When can I access my money? I've been putting money in, and Brian, I understand the difference between traditional and Roth, and we do all these great things, and I've been contributing for 10 years or 15. I'd like to know when I can have access to my money. So the first thing you need to understand is that there is a rule, and it has to do with your age, and it's age 59 and a half. The government has said we are giving some great tax advantages to 401k plans, but we really want you to not touch those until retirement. So if you decide to access or somehow tap into your monies before age 59 and a half, and it's not through a loan, we are going to penalize you 10% of the gross amount as a penalty, kind of a slap on the wrist. So we always tell people, try not to go after that money before 59 and a half, because all you're doing is giving up 10% of that amount to the government, and I don't think anybody really wants to do that on purpose. So try to avoid that. But 5 ways to access the monies inside your account. The first way and the second way are the most common. The first way is I separate from service. I decide to go get another job or leave the employer I'm at, in which case once you terminate and separate, you can then move your account to your new employer's 401k plan. You can move it into an IRA account, or you could cash it in, which we certainly don't advocate, but that is an option. Sometimes if your plan's balance high enough, you could leave it with the existing employer until you decide you want to do with it. But that is a triggering event that does let you have options in terms of, hey, can I get into the monies in my account, and then what can I do with them? And that is what we call separation from service. The other is retirement. And assuming if you worked from or at your employer until age 65 when you retire, once you retire officially, then you can access the monies in your account without penalty. Disability, if you satisfy Social Security's definition of disability, you are able to tap into your account without penalty. Death, unfortunately, if you do pass away while working, obviously you won't receive your proceeds, but you do need to put a beneficiary designation on your account so that you can leave your account to the people that you feel it's appropriate to leave that to. So we always want people to stress that beneficiary designations are kept up to date. And in most cases, you can do that right on your account when you log in on your computer. So please review those beneficiary designations. They are extremely important. They override any will or any other instructions that you may have. So if it's not up to date, and let's say you went through a divorce and your ex-spouse is still your beneficiary and you pass, your will may say your new spouse gets the money of all the other assets, but your 401k account is going to go to the ex-spouse. So it is very important to check those things and make sure that they are up to date. Now, Arizona, if you reside here, is a community property state. And in a community property state, you must name your spouse as the beneficiary of your account unless they sign off on it and say it's okay to leave it to somebody else. Now, that can be a tough conversation, but you do have that option. But in most cases, if you're married, you're going to name your spouse as the beneficiary, and then maybe we call as a contingent beneficiary, you might name somebody else. And that means if your spouse isn't here as the primary, then the monies go to whoever you name as the contingent beneficiary. But it is very important to keep those up to date. And if you have any questions about how to do that or what is right or what isn't right, please feel free to call us here so we can walk you through that. And then hardship. Hardship means if you can't pay certain medical bills or other things where you don't have the resources beside your 401k account, you may be entitled to access those monies inside your account without penalty to do that as well. That's kind of a last resort, but it is there. And some plans, depending on how they're designed, might allow for pre-retirement or early retirement withdrawals. That's not something we want to get into here, but if you think that is an option or it's something you do want to look at, you can certainly call so we can try to help you navigate that as well. So hopefully that may have cleared up any questions you had. Again, we do want to make sure that everybody understands plan provisions. We just think they're so important in understanding your particular plan and then how to maximize the growth of it and the benefits inside of it. But if obviously there's any questions or we can be of help with financial planning, determining your risk tolerance, making sure your investment allocations are appropriate for you or for your family based on the planning inside your 401k or outside planning or anything else in general, please reach out to either your HR rep or directly here to the Baintree team. We are here to help. And again, there's no cost for any employee to ask us questions or have us help them or even utilize the technology that we have here because we have some wonderful tools at our disposal and we'd love to be able to tell you about them and have you utilize them as well because it's just an extra benefit to you. So again, we're here to help and answer any questions you may have. So hopefully we hear from you and hopefully we can help you make your account grow and make sure it's a critical and coordinated part of your financial planning. So I appreciate your time. And again, I look forward to talking with you soon. Thanks and take care.